Welcome back to Talk Tickers, the show for the experienced investor who wants the signal, not the noise. We are skipping the headlines today and going straight to the balance sheet.
Wow.
We're dissecting a print that dropped this morning, and frankly, it woke up the entire regional banking sector. We're looking at the Q4 2025 earnings for Citizens Financial Group, ticker CFG.
That's right. And just to timestamp this, it's Wednesday, January 21st, 2026. The print hit pre-market, so we've had a full session for the market to, cast its vote.
And what a vote it was. I mean, we always say price is the ultimate truth serum. You can spend whatever you want on a call, but the tape doesn't lie. The stock popped about 6% today, closed up, $3.50 at 63.27?
Then the volume, that's what I was watching.
The volume was heavy, yeah. About 5.8 million shares. That's not retail. That's institutional conviction.
Exactly. That tells you the entire psychology is shifting. I mean, for 2 years, the regional bank trade has been all about fear. Balance sheet repair, capital preservation. Is CRE going to blow them up?
Right. Survive till 25, or I guess now 26.
Exactly. And today's move, it signals a pivot from, cautious to constructive. The market is finally buying a new narrative for Citizens.
Is it just?
A pivot from playing defense to playing offense.
I like that. From defense to offense.
Yeah.
Because this wasn't just some boring, we cut costs quarter. Looking through the deck, you've got this massive private bank build out that's actually making money.
Which is a huge spoiler.
You have a new efficiency program called Reimagine the Bank, and the big one net interest margin is finally moving the right way.
The holy grail in this REIT environment.
Okay, so let's unpack it. Let's ground the conversation with the headline numbers first. Just, the snapshot.
All right, so bottom line, earnings per share, EPS, came in at $1.13. That beat the consensus of $1.11.
A 2-cent beat. Was it a clean beat? Or was it, accounting magic?
Totally clean. And that's the key, right? Sometimes you see a beat because they release a bunch of loan loss reserves. This wasn't that. This was core performance.
Okay, and top line.
Revenue was $2.157 billion, also a beat. And it's up 8.6% year over year. Net income was $528 million, up 32% from last year.
32% is a big jump. But,
Wow.
You can buy revenue. You have to earn margins. Where did the NIM land?
This is the most important number on the page. Net interest margin, NIM, it expanded to 3.07%.
And what's the trend there?
That's up 7 basis points from last quarter. And get this, up a massive 20 basis points year over year.
20 basis points. So for anyone listening who needs the quick takeaway, why is that so significant right now?
Because for 2 years, banks have been in a vice grip. Deposit costs were soaring. Everyone wanted 5%.
Of course.
But their old loans were stuck at 3%. That just crushes your margin. Seeing a bank, especially regional, expand in like this means that Vice is loosening. They're repricing assets higher and keeping a lid on funding costs. It's proof the model is working.
Got it. What about the other metrics? Efficiency ratio.
Came in at 62.2%.
Which is 4.
It's decent. I mean, it's how much it costs to make a dollar. 62 cents isn't world class. You want to see that in the 50s. But they're in a heavy investment mode, which we'll get to.
Right. And before we get to that, the fees looked really strong, too. This wasn't just a lending story.
Not at all. Wealth fees were up 22%, a record quarter for them. And capital markets fees were up 16% year over year.
There's a little note on that in the transcript.
Yeah, this is a great little nuance. Management basically said it could have been even better. About $20 million in deal fees got pushed from Q4 into Q1 of this year.
Push why? Deals fell apart.
No, just timing. They mentioned the government shutdown drama, things like that. So that revenue isn't gone, it's just deferred. It means Q1 already has a $20 million head start. A nice little tailwind.
Okay, so the core engine is running well. Let's pivot to what I think is the most interesting part of this whole story. The idiosyncratic growth driver, as we call it.
The private bank.
The private bank. This is the main event. A couple of years ago, they made this huge bet, right? They hired all these teams, basically lifted them out wholesale from places like First Republic.
And Wall Street was so skeptical. They said, can they afford these bankers? Can they even integrate them? It was a huge gamble.
And the numbers suggest the gamble paid off. They ended the year with $14.5 billion in private bank deposits, $10 billion in client assets, $7.2 billion in loans.
And here's the kicker. It's actually profitable. I mean, usually these things drag on earnings for years.
Yeah.
Management said the private bank added 10 cents to EPS in Q4 alone. And for the full year, it hit a 25% return on equity.
Wait, pause on that. A 25% ROE.
25%.
In bank, 15% is considered great, 25% is, that's almost hedge fund territory.
It's stellar. It completely validates the strategy They're just aggressively hiring these teams, 10 teams since launch, and these are people bringing their entire book of business with them.
Okay, but I have to play devil's advocate. You grow a loan book that fast $7 billion that usually screams bad underwriting. Are they just buying risky loans to get the growth?
A fair question. We looked for that. We dug into the credit supplement. You know what the credit losses in that portfolio are so far? Zero.
Zero. Not one default.
Zero. Now look, the book is young. It hasn't been through a real recession yet. But this type of lending, jumbo mortgages to super high net worth people, it's historically very safe. They are basically copying the First Republic credit model, which, for all its other faults, had pristine credit.
And the deposits. Are they just hot money chasing rates? Or are they sticky?
They seem really sticky. Management said about 36% of those deposits are non-interest bearing.
Zero cost funding. That's the dream.
It's the golden ticket, and most of the rest is in checking with interest, which pays next to nothing. So your low-cost deposit mix is in the mid-40s. That is what fuels that NIM expansion we were just talking about.
That's huge. And it sounds like they're stepping on the gas for 2026.
Oh, yeah. They're targeting 18 to 20 billion in deposits and 11 to 13 billion in loans. It's creating this flywheel, you know? The commercial bank refers to wealth. Wealth refers back to the bank. It makes them way less reliant on what the Fed does next month.
Okay, so speaking of improving the bank, we have to talk about the new buzzword, Reimagine the Bank.
Reimagine the bank. It definitely sounds like something a consultant came up with over a long weekend.
It really does. But there's real money behind it. The goal is $450 million in run rate savings by the end of 2028.
Right, but they do have to spend to save about a $50 million cost up front in 2026.
But they say that's offset by about $45 million in benefits this year. So it's basically a wash in year one.
Yeah, net neutral this year, then all gravy later on.
What I found fascinating was the how. I mean, usually efficiency is just a code word for firing people and closing branches. They got surprisingly specific about AI.
They really did. It feels like every CEO has to say AI 5 times on an earnings call now.
Right, or the stock drops 10%. But this was different. They gave actual use cases. Management said they think they can get 50%, 50 of call center volume handled by AI or other non-human interactions.
50%, half of their call volume. If they can do that, that's a massive reduction in overhead.
It's huge. And it wasn't just call centers. They talked about coding. Using AI to get 5x to 10x productivity improvements from their software engineers.
So the AI rates the code, the humans just QA it.
Exactly. It's the co-pilot model on steroids. If they could really do that, it just fundamentally changes the operating leverage of the bank. And I think that's why the market is giving them so much credit today.
Right. They're not just shrinking to save money. They're investing to become more efficient.
Before we get too carried away, though, we should check in on the ghost of Christmas past, commercial real estate. That general office portfolio.
The ticking time bomb?
Is it still ticking?
It seems like it's being diffused. The reserve coverage on that book is now at 10.8%.
So they have over 10 cents set aside for every dollar of office loans? That's a huge cushion.
It's massive. And what's interesting is that the non-accruals, the loans that have actually stopped paying, were down a little bit.
So the bleeding stopped.
It's more like the wound is cauterized. They're sticking to their view of about a 20% lifetime loss rate. The really scary part of the book is being worked down and is just a tiny piece of the balance sheet now. It's not the headline anymore, which is what you want.
Okay, so the past is handled. The future is AI and private bankers. Let's talk about the guidance for 2026.
It was very, very strong, especially compared to the pretty tepid chatter we're hearing from some of their peers.
They're guiding for a net interest income growth of 10 to 12%, fee growth of 6 to 8%, and operating leverage of over 500 basis points.
Okay, pause on that for a second. Operating leverage of 500 basis points. That just means revenue is growing 5% faster than expenses.
Which is incredibly hard to do.
It's pure profit margin expansion. It's the proof that all the investments they made in the last couple of years are finally hitting the bottom line.
And on top of that, they're returning a lot of capital.
Aggressively, targeting $700 to $850 million in buybacks for 2026.
And they can afford that?
Easily. Their CET1 capital ratio is at 10.6%. They've got plenty of dry powder.
And they reaffirmed their North Star goal, that 16 to 18% ROTCE.
Which is top-tier performance. Now, we do need to add a little context. This guidance all depends on a very specific macro view.
Right. What are they assuming the Fed does?
The guide assumes 2 Fed rate cuts this year, June and September, ending with the Fed funds rate around 3 to 3.25%.
So a Pretty orderly soft landing, no surprises.
Exactly, a Goldilocks scenario. If rates fall faster or stay higher, the math changes a bit. But the takeaway is they don't need a miracle to hit these numbers, just a relatively stable economy.
So let's put it all together. What's the so what for an investor looking at CFG today?
It's that the pivot is complete. I mean, this was a bank that was totally defined by its non-core runoff portfolio. That's down to a stub now, about $2.5 billion. They've successfully transitioned to a bank playing offense.
And the market sees that.
The 6% pop today says investors believe this margin expansion is real and sustainable. It's not a blip. And they're differentiating themselves. While other banks are just hoping for loan growth, Citizens is actually manufacturing it through the private bank and things like ALOCs, where they're number one.
And they were clear about M&A, right? They're not going shopping.
Very clear. They said they are not looking for deals. The focus is organic growth and reimagine the bank. And investors love to hear that. No surprise acquisitions, just focus on execution.
So a clean beat, real margin expansion, a credible tech story, and a focus on execution.
It's a pretty clean story. Now they just have to deliver.
All right, that brings us to my favorite segment, the part where we take all this serious analysis and twist it into something a little more adventurous.
The do not try this at home portion of the show.
Exactly. This is not financial advice. We pitched 2 wild high-risk trades based on the call. You're up first. What have you got?
Okay, I'm calling this one the private equity Lazarus trade.
Lazarus, as in rising from the dead.
Precisely. Management explicitly said financial sponsors, PE firms, are finally coming alive. Their capital markets pipelines are strong. We know that $20 million in fees got pushed into Q1. It all points to one thing. The deal market is back.
So how do you trade that?
You go long CFG. You're buying it for that capital markets pop, but you pair it by shorting the volatility index, the VIX.
Whoa! Shorting the VIX. That's picking up pennies in front of a steamroller.
It is wildly dangerous. But think about the logic. M&A only really happens when volatility is crushed. CEOs don't do massive deals when the VIX is at 25. They do them when it's at 12. So if Citizens is right and deal mania is back, CFG's fee income explodes and the VIX gets squashed, you win on both sides.
That is terrifying, and I love it.
Oh.
Okay, my turn. I'm calling this the AI efficiency spread.
Okay, let's hear it.
This plays on that Reimagine the Bank stuff.
Yeah.
They're claiming AI will replace half their call center volume, 50%. If a super regional bank, not some fintech startup, can actually do this, think about who loses.
They're vendors.
Exactly. So the trade is long CFG and your pay. Short a basket of BPO business process outsourcing call center stocks.
Oh, that is brutal.
It's a perfect hedge. If Citizens really automates, their margins go up, stock goes up, but all that call volume, they're not sending out anymore.
Yeah.
That comes directly out of the pockets of the BPOs. You're hedging the bank's execution risk with the literal demise of their suppliers.
That's actually a really clever pairs trade. You're betting AI is deflationary for the service providers, but margin accretive for the companies that use it effectively.
Precisely. But again, to be very clear, this is not financial advice. Please do not go shorting call center stocks.
We like our listeners solvent.
All right, let's wrap this up. Main takeaway.
Citizens posted a clean beat. Margin expansion is back, and it looks real. And that huge bet on the private bank is paying off, big time. They're taking market share and doing it profitably.
And the thing to watch going forward.
It's all about execution on Reimagine the Bank. That $450 million savings target, that's where the next leg of alpha comes from. If they can hit that, their 16-18% return target becomes very, very real.
And that is a wrap on Citizens Financial Group, a bank successfully pivoting from defense to offense. As always, you can check the transcript for all the details. We will catch you on the next deep dive.
See you then.